Big tech is rallying again, even as warning lights flash across the AI supply chain and Federal Reserve policy becomes harder to read. Welcome to vTalkInsight, Equity Pulse Daily for July 7th, 2026, where we connect today's macro shifts and company headlines to the equity tape. The dominant macro development for equities is the Federal Reserve stepping back from clear forward guidance and leaning into a more data-dependent stance. Markets broadly expect rates to stay on hold this year, with inflation prints doing the heavy lifting for policy decisions while labor data fades a bit into the background. That change in communication raises uncertainty around each policy meeting because investors have less clarity on the reaction function and need to reprice probabilities more often. Yet the equity tape still looks calm for now, with the main U.S. benchmark up about 0.7% yesterday and implied volatility sitting in mid-teens, a disconnect that points to potential future air pockets if the data surprise. The cushion for risk assets comes from clear disinflation trends. Oil has dropped from triple digits into the $60 range. Tariff and services inflation are easing, and the latest ISM Services survey showed a notable fall in prices paid. With unemployment steady around 4.2% and growth slowing only gently, the Fed faces less urgency to tighten further, allowing real yields to drift lower and supporting both equity valuations and credit markets. Credit is reinforcing that story. Investment-grade and high-yield bonds continue to see strong demand, spreads remain tight, and all-in yields look attractive enough that many investors are focused on collecting carry rather than hedging for recession. That combination of benign inflation, stable policy, and strong corporate balance sheets underpins a soft landing narrative that still favors risk assets, even if policy communication keeps rate volatility elevated. Globally, the macro picture is more mixed. The yen is deeply out of favor and heavily shorted, serving as a funding currency for carry trades into higher-yielding markets, while the U.S. dollar remains underowned among long-term investors despite U.S. economic outperformance. Those positioning extremes can amplify moves if the Fed's tone or growth data shift, so equity investors may want to treat currency and policy surprises as key triggers for the next bout of volatility. The second big pillar for equities is earnings, where the message is still broadly supportive. Profit expectations for the S&P 500 keep grinding higher, with 2027 estimates rising from $357 to around $400 since the start of the year. With inflation pressures easing and input costs, such as energy, moving lower, that upgrade cycle is improving both margins and the outlook for top-line growth. Importantly, growth is no longer confined to a handful of AI and semiconductor names. 7 of 11 S&P sectors delivered double-digit earnings gains last quarter, and median earnings growth has picked up across the U.S., Europe, and Japan over the last 2 reporting seasons. Small caps and the equal-weighted S&P have begun to outperform, while banks and energy are expected to contribute more to index-level gains as the year progresses. Market focus is shifting from pure liquidity to fundamentals as we head into the next reporting season. Expectations are now elevated after a long run of positive surprises, which means single-stock dispersion is rising and misses can be punished quickly. That tilt is consistent with commentary that leadership remains concentrated and valuations full, driving more emphasis on stock selection and sector diversification rather than simply riding broad index exposure. Regionally, Europe and Japan are slowly reclaiming some attention. European indices recently set new highs before pausing, and institutional investors describe the region as underowned relative to the U.S., with renewed allocations helped by active mergers, acquisitions, and rising defense spending. In Japan, policy is structurally supportive of equities through buybacks and dividends, even as yen weakness and higher local bond yields create a more complex backdrop for global allocators. Asia shows the sharpest divergence beneath the surface. South Korean equities benefit from record profits at Samsung and SK Hynix, yet see significant foreign outflows and a still undervalued won, while industrials and defense-related heavy engineering in Korea and Japan outperform as military budgets rise. Put together, the earnings picture still leans constructive, but with a much greater premium on understanding which regions and sectors are now carrying the growth baton. The most contested battleground in equities remains the AI and semiconductor complex. On one side, fundamentals in memory look exceptionally strong, driven by data center demand and constrained supply. Samsung is expected to report quarterly profits that are roughly 18 times higher than a year ago, while SK Hynix is forecast to deliver triple-digit earnings growth on the back of disciplined capital spending and tight supply-demand conditions. SK Hynix plans a $28 to $29 billion listing in the U.S., one of the largest international offerings, designed to give American investors more direct access and close its valuation gap with Micron, where forward earnings multiples still run at about 6.2 times versus 7 times. Semiconductor stocks have led recent rebounds, with the sector index outperforming and lifting the S&P 500, helped by optimism ahead of Samsung's results and the SK Hynix debut. On the other side of the ledger, warnings about a bubble are getting louder. Earnings revision breadth in semis is already around 75%, and some expect a correction of as much as 30% even within a broader bull market as momentum cools from peak levels. Flows in Korean tech underline the risk, with leveraged single-stock ETFs turning parts of the Kospi into what some describe as a casino, retail investors heavily levered into SK Hynix, and institutional money stepping back just as policymakers discuss potential taxes on excess chip earnings. Supply chain strains add another layer of uncertainty. NVIDIA faces significant delays in its next-generation AI server platform, driven by bottlenecks in producing complex circuit boards, with the timeline reportedly slipping by more than a year. Those issues have already weighed on several Asian hardware suppliers and raised questions about whether the market is overestimating the scale and speed of the AI data center build-out, especially as only a fraction of planned projects may ultimately be completed. At the same time, other parts of tech are quietly consolidating their position. Broadcom has extended its custom chip partnership with Apple through 2031, giving it long-term revenue visibility and tying its fortunes directly to Apple's AI and connectivity roadmap. Microsoft is refocusing spending from gaming toward artificial intelligence and a new Office 360 suite. Tesla just delivered a strong sales beat that sent the stock up 6.7%, and Micron's long-term supply agreement with Ford underlines how AI and memory demand are bleeding into automotive technology. These cross-currents are encouraging a gradual rotation within tech. Capital is shifting from pure hardware and Korean names toward hyperscalers such as Amazon and into software, which had been under-owned for years and now offer a different way to access AI-driven growth. For equity investors, the key questions over the next few weeks are how strong Samsung's numbers and guidance prove to be, how SK Hynix prices and trades in its U.S. listing, and whether NVIDIA and the hyperscalers can reassure the market that AI infrastructure spending is sustainable rather than speculative. Beyond immediate earnings stories, several policy and flow initiatives could reshape the equity backdrop over time. In the U.S., the new government-backed Trump Accounts app has seen rapid take-up, with more than 6 million family accounts opened and around $50 million in parental contributions in its first weekend. Each child born during the Trump administration receives a $1,000 Treasury-funded contribution invested in the S&P 500, accessible at age 18, with major private commitments from Micron and the Dell family and operational support from Robinhood and BNY Mellon. Passive flows are also in focus. SpaceX is set to join the Nasdaq 100 with an initial index weight below 1%, yet that still implies roughly $4.3 billion of buying from index trackers, helping to push the stock higher ahead of inclusion and potentially forcing funds to trim other constituents. At the same time, C-Square is planning to raise up to $1.35 billion in a U.S. IPO to fund AI infrastructure and reduce debt, while overall ETF demand has surged, with clients directing a much larger share of flows into passive vehicles than just 6 months ago. Geopolitics continues to rewire sector leadership. The Russia-Ukraine war, tensions with Iran, and mounting pressure inside NATO are driving a rapid increase in defense budgets, with European economies on track to spend around 2.5% of GDP on defense this year, and the White House pushing for 5% by 2035. Italy's planned €17 billion increase in defense outlays is lifting Leonardo shares. Lockheed Martin's $3.5 billion acquisition of Ultra-Maritime underscores rising interest in undersea warfare technology, and defense-related industrials in Korea and Japan are outperforming as orders and backlogs grow. Energy markets add both relief and risk. Brent crude has slipped back towards $70 to $75 a barrel as OPEC Plus agrees modest quota increases and Saudi Arabia cuts prices to Asia, even while tanker traffic reroutes around the Strait of Hormuz and Red Sea, keeping shipping and insurance costs structurally higher. Lower oil prices feed the disinflation story and help margins today, but persistent geopolitical tension around key choke points and rising margin debt have some observers flagging the potential for an equity correction between August and October, especially if the Fed's evolving framework, large share unlocks at names like SpaceX, or any disruption to petroleum products collide with stretched valuations. Stepping back, the near-term picture still looks constructive, yet the path is narrowing. The interaction between a less predictable Fed, lofty AI-linked valuations, rising single-stock dispersion, and powerful structural flows from policy and passive vehicles will likely determine whether equities consolidate, correct, or resume their grind higher. Watching upcoming Fed meetings, the next earnings season, AI supply chain headlines and signs of stress around leverage and retail activity will be critical for understanding where equity leadership and volatility go from here. To wrap up, equities are trading against a backdrop of supportive disinflation, resilient earnings, and tight credit spreads, while the Federal Reserve's move to a data-dependent framework injects more uncertainty into each policy meeting. Leadership is broadening beyond mega-cap tech, yet the AI and semiconductor complex sits at the center of both the upside narrative and the downside risk, with Samsung, SK Hynix, NVIDIA, and the hyperscalers likely to dictate near-term swings. Structural forces, from the Trump accounts program and rising ETF usage to record defense and AI infrastructure spending, are building powerful long-term flows into risk assets, even as geopolitics, shipping costs, and elevated margin debt leave room for an air pocket later in the year. Over the coming weeks, the key signals will be inflation data, Fed communication, semiconductor and hyperscaler earnings, and how far single-stock dispersion stretches as expectations peak. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.